Welcome to the Opal Dividends Podcast with Austin Graff and Adam Muller. My name is Jay Coulter, and on this episode, we're going to discuss several topics around the team's outlook for 2024 and wrap up with our popular Bull and Bear segment. Let's get right to it. Austin, when you look at the U.S. equity markets for next year, what do you see?
Yeah, there's a number of kind of puts and takes in the market right now. If you look at it, valuations are kind of rich for where interest rates are, but earnings have held up better than expected. It really depends on what happens with the economy in 2024, which will tell us what's going to happen with equity markets. If analysts are overshooting expectations for earnings, we would expect markets to sell off. If earnings remain resilient and interest rates continue to kind of normalize where they are, we think there's room for equities to run here. But I would caution listeners that we are kind of setting up for the opposite of what we had at the end of 2022, where people seem to be overly optimistic about the market and ignoring some of the headwinds that could be coming our way. At the end of 22, people were overly pessimistic and ignoring some of the tailwinds. So we could be in for maybe a sell-off into 2024.
You're right, Austin. It is the opposite of last year. Adam, what's your thoughts on next year as it relates to the equity markets?
Yeah, I think we're in a really interesting spot because to Austin's point, like if you go back 12 months and you told people in 12 months from now, which is today, you're going to be sitting here and there will not have been a recession. We will not have felt it. We'll still be talking about its imminence in the exact same way. People would have been like, "You're insane," but yet there we are. Here we are. And it feels like people's opinions have really sort of barbelled to it's coming, get ready, to on the one hand and soft landing on the other hand, which means that the reality might be just somewhere in the middle and we kind of muddle along and drift up. What will be interesting to see, it'll be very interesting to see, like you look at 2023, it feels like a good year, but really it was a handful of stocks that did well, that brought the whole market with them, or brought the index with them, but left the rest of the market kind of like, So will that broaden out? Or will there be another handful of winners, or will things retrench a bit? Which is a long-winded way of saying anything can happen.
Yeah, and that's the problem with forecasting and outlooks, but it's still an important aspect of what we do. So speaking of that, Austin, when you look at the Fed and their potential moves for next year, what are you looking at?
It's tough. I mean, the Fed seems to still claim to be data dependent. However, their desire to provide a forecast to the market has kind of hamstrung them a little bit, where a lot of the market is trying to guess what the data is going to say and therefore guess where the Fed's going to go. Right now, in the short term, it seems the market's guessing the Fed's going to have to be reducing rates in the first half of 24. But honestly, it doesn't appear as though a lot of data or economic data is actually pointing to that outcome. So it kind of feels like the Fed's backed itself into a corner with this forecasting methodology, especially with their past record in forecasting, which is atrocious. So I think the market's basically saying like, hey, the Fed sucks at forecasting, so we're going to come up with our own forecasts and try to front run them. And at the end of the day, the market's been wrong about that the last 6 times. So I think the market and the Fed are really bad at forecasting economic outcomes. And we need to kind of look at the data and make decisions based on what the data is telling us today.
Adam, what are your thoughts on the Fed in next year?
Look, I think everyone that forecasts market moves, whether it's the stock market, whether it's interest rates, bonds, etc., everyone, they're paid to have a forecast. But then if you took them aside and had a beer and you said, "What do you think about your forecast?" They'd be like, "I don't know. I hope I'm right." And that's what forecasting is. So I don't think the Fed's any different than that. Like they're trying to do their job. They have to keep their cards close to their vest. They're all in on the 3% inflation, but we don't quite know which. Like there's ways to fudge which statistic they're actually looking at to get there. Some people might argue that they've gotten there. Some people might argue there's a ways to go. But it still feels like the market is anticipating rate cuts that, unless the Fed changes their stance and risks losing credibility, aren't going to happen as early as the market prognosticators think they are. And that could make for an interesting moment when one of those two opinions moves towards the other.
Was that a Freudian slip at 3% versus 2%? Or do you have some knowledge of the Fed changing its target that the rest of us do?
But what did I say?
You said 3%.
Isn't that their target?
I thought their target was 2%.
Oh.
So let's switch to energy markets. Austin, what are your thoughts on the energy markets for next year?
I think the energy market is one of the more unique markets in the current environment. In a market where everyone seems to be assuming a soft landing is coming, the energy market appears to be assuming a recession's on the horizon. And a lot of that, I think, has to do with the fact that you have a lot of investors who are more focused on reduction in traditional forms of energy being carbon-based fuels, and more of a focus on green energy. However, more recently, we've seen that green energy has struggled as interest rates have moved up and it increased the cost of financing. So what should be a bullish tailwind for energy markets has actually continued to be a headwind. And I kind of expect that to change at some point in the near future. We're either going to see that energy markets are right and we're heading into a recession, or we're going to see a situation where there is no recession on the horizon and people start to realize that energy is extremely cheap and they start to get on board with energy stocks and some of the energy commodities.
Yeah. Adam, do you have any thoughts on energy markets for next year?
Well, it's very interesting what Austin said there about how energy markets pointing to a recession. Because if over the last couple months you've seen sort of energy and that old favorite gold make moves that are that are consistent with kind of recessionary fears, but you haven't seen that in the equity markets. Who's right? Who's going to be proven right? Who knows? The other interesting thing about energy over the last 4 or 5 months is we've seen several large acquisitions, several large M&A deals, consolidation in the Permian Basin, and so what are the big the big energy companies with balance sheet capacity? Are they pouncing on what they perceive as an opportunity to get something at a good price?
Adam, speaking of M&A, this is a great time to kind of look out into next year and see what you think the M&A markets might look like next year.
I think it's going to look. I think M&A at some point in the next few quarters will start to rebound. I think we've probably seen the trough, and I think really what deal makers needed was to come to a point where they didn't think rates were going to increase that much. So it's not just about the level of rates in terms of thinking about M&A. It's also about where are they going. So if there's some stability in rates, if rates are either going to stay where they are or trend lower, you have a lot more ability to execute and structure transactions. And it feels like we're at that point, and M&A demand is probably pent up. And my guess is the next 12 to 24 months could be a very good time to be a M&A banker or to own businesses that generate fees based off of mergers and acquisitions.
Austin, what's your take on M&A for next year?
I think it's setting up well for a pretty kind of positive year. It tends to be relatively cyclical, the business. And as we've seen with the rapid rise in rates, everyone's kind of put their pencils down and stopped working on new transactions. We've seen the IPO market kind of lock up. We've seen financing markets kind of lock up. And as rates have come back down a little bit, or at least stabilized, we're seeing some activity pick back up. We're not seeing things back to what I would consider normalized levels, but they're definitely off the trough. So if you think about where you want to be investing along the cycle, if you're to own companies with leverage to M&A fees, you probably want to be investing when the market's starting to open, and many of the stocks haven't reflected that opening in their valuations.
And you've seen a few big transactions recently. We mentioned it already in the energy space, but also in like the pharma biotech space, which are traditionally sectors where M&A is an important part of their overall strategy. So you would expect those to kind of come back first.
The other interesting thing is if depending on what the Justice Department does, and the who's the other one, the FCC, the people that are actually opining on if these deals will get approved. I mean, recently we've seen some significant transactions that were, I mean, the Microsoft deal that Microsoft ended up winning over the long term. We saw the Broadcom deal where Broadcom ended up getting it through regulatory authorities in the long term. I think some of the freezing, in addition to the interest rate environment, also had to do with the regulatory environment. And many corporates are seeing that there is kind of a path through the regulatory environment. So there is a way to get these deals done. So there is more of a desire to put the effort into getting deals done than there was 6 months ago.
Austin, a big elephant in the room for next year is going to be the 2024 election cycle. What do you see the markets doing in anticipation to the run-up for the actual election?
Yeah, markets tend to be positive running up to an election because politicians tend to want to put some wins on the scoreboard heading into an election year. I think this might be a little bit different because of the amount of dysfunction in Washington. I think that the split government and the desire to not want people to put points on the board from both sides may prevent anyone from getting much done, similar to what we've seen over the last year and a half to 2 years. So I'd be hesitant to, I would say, put all my money behind the fact that election years tend to be good years for the market, just because that's what's happened in the past. I think we might be in a bit of a unique political environment right now that might prevent that from being the case going forward.
Adam, you have any thoughts on elections and investing next year?
Yeah, I think as far as election years go, it could be one of the more volatile election years, based on who the candidates are, based on other things that could happen. For example, if the likely candidates don't end up being the candidates for some reason, which on the one hand wouldn't be surprising, but on the other hand would be very shocking to markets. And then who is the person that steps into that void, et cetera. So there's a lot. And then of course, I'm just given people's ages and things, who knows what's going to happen. So it's a little more volatile than the typical, if the Democrat's leading in the polls and is talking about, clawing back profits out of pharma companies and oil companies, blah, blah, blah. What does that do versus a Republican who's going to lower taxes and be good for business? Like the sort of typical, the stereotypes, I feel like are a little bit out the window this time around. And there's a lot of other kind of external things that could happen. Not to mention, legal issues and wars in different parts of the world. There's a lot of geopolitical and political risk and uncertainty, which could just add to the volatility as those events kind of unfold through 2024.
So, Adam, AI has dominated the news cycle for a year. How do you see the AI story playing out in 2024?
Yeah, I think my take is I think it's going to be more of the same. I think that we got that sort of AI kind of to the sort of the people's sort of the average American's consciousness. No one had thought about AI 12 months ago, right? And then all of a sudden Chat GPT shows up and people have it on their phones and people are doing all kinds of fun stuff. And NVIDIA goes up a bazillion % in a short period of time and people make a lot of money there. And it pulls the rest of the chip space with it. And all of a sudden everyone's talking about AI. You're hearing it from your Uber driver and your cab driver asking you what you think about AI. But it needs to transition from sort of like, water cooler talk to actual productivity improvements. And I think that'll be the story over the next 12 months because it's come so far so fast. And I think we're at the point now where it starts to actually get implemented in ways where companies can't, instead of just saying AI 500 times on every conference call, they can actually point to specific metrics and things that they've used AI for that will increase their productivity, help their margins, And if companies can do that, then I think it remains a huge story, and that may run for several years.
Excellent. Gentlemen, let's pivot to our Bull and Bear segment. If you're a first-time viewer of this segment, here's the deal. I'm going to throw out a stock, going to give it to one of them, and they have less than 50 seconds to give their bull or bear case for it. Adam, I'm going to start with you. McDonald's.
So McDonald's just announced some new restaurant initiative called, what is it called?
Cosmics.
And I'll tell you this, unless Cosmics has milkshakes that have Ozempic in it, I don't know what they're doing. I also don't know why you make such a big stir about something that's going to not move the needle for years to come, if ever. If I were them, I would have kept that quiet, done the pilot restaurants, and see how it goes. By putting that front and center, what are you hiding? So I'm a bear on McDonald's.
Austin, Verizon.
I'm a bull on Verizon. They've invested a ton of money into 5G over the last few years. They've got a pretty bad reputation in the market right now, just in the way that they've been spending their cash and the fact that they've been blowing through capital while they've let the broadband companies steal market share in the wireless market. The winds are starting to change in that argument, and you can currently pick up Verizon at a ridiculously cheap multiple. At the same time, you're going to get a nice solid dividend that will likely grow going forward. As they ramp down their investment in 5G, free cash flow is going to grow substantially in the next year to 2 years. And that could be a tremendous tailwind for the equities.
Adam, Tesla.
Look, I'm a bear on Tesla, and not just because you've got the crazy CEO saying weird and random things and that make him have to fly to the Middle East to make up for it. But the unions are coming for you, and it remains to be seen if they can keep them at bay or not. But if Tesla lost that advantage that they have by having a non-unionized workforce, that's really gonna hurt them. So until I have a view on if or if not that's going to happen, I'd be very cautious about Tesla.
Austin, bull or bear on Morgan Stanley?
I'm bullish on Morgan Stanley. We talked about the M&A environment, and Morgan Stanley has some, I would say, exposure to M&A while also having the stability of the wealth management business. Currently, it can be purchased at a pretty attractive price, and we think there's some substantial growth ahead at nice returns on capital that should support an organically growing business and continued kind of growth in share prices. So Morgan Stanley is a buy at this point.
Adam, Berkshire Hathaway.
I'm bullish on Berkshire Hathaway. We lost Charlie Munger recently, which is a huge loss for not just for the investment community, but sort of for the world. But good for Charlie, 99 years old. That's very impressive. But Berkshire, even if it didn't do another acquisition for the rest of its time, is just a collection of wonderful cash generative businesses. And as long as whoever steers the ship doesn't, screw it up somehow, you own it for the long term, and you'll do just fine.
Austin, let's wrap up with Pfizer.
Bull on Pfizer. It's gotten a bad rap over the last, call it 12 months, because they've ramped down their COVID-related business, and it's caused some noise in the numbers that are kind of obscuring the long-term organic growth potential of the business. I think once we lap those numbers, you'll start to see a much more clear picture of the growth dynamics for Pfizer. And when you start looking at those numbers, the current valuation is absurdly cheap. So we just have to get a little further away from some of the COVID era medications and vaccines. And once we get through that, it will be much clearer that Pfizer continues to be a solid growing business with resilient free cash flows.
Excellent. Gentlemen, thank you so much for your time. To learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.